Have you ever just stared at a stock chart and all you see is, well, chaos? Just a messy scramble of ups and downs? You are definitely not alone. But what if I told you there might be a hidden structure under all that noise? Today, we're going to decode a really fascinating theory that tries to find exactly that, the Elliott Wave Principle. This is the big question, right? For years, traders and analysts have wondered, is it all just random? Is there any way to predict what's coming next?
Well, way back in the 1930s, a guy named Ralph Nelson Elliott came up with a pretty radical idea. He said, you know what? Markets aren't random at all. He believed they actually move in these repetitive patterns, and that those patterns are driven by the natural rhythm of human emotion, basically the constant swing between optimism and pessimism. So, what does this pattern look like? Well, the entire theory really boils down to one simple but incredibly powerful 8-wave structure. Okay, first you get the main push in the direction of the trend. This move happens in 5 distinct waves. Think of waves 1, 3, and 5 as the real power moves. They're the engines driving things forward. And in between, waves 2 and 4 are just the market catching its breath, pulling back a little before the next push. Then, after that big 5-wave push, you get a 3-wave correction that moves in the opposite direction. We label this A, B, and C. And that's it. That 5-3 combo makes one complete 8-wave cycle. Now, here's where it gets really cool. This 5-3 pattern is what we call a fractal. It's like one of those Russian nesting dolls. Each one of the big waves you see is actually made up of smaller, identical 5-3 patterns. And this structure repeats on every single time frame, from a 1-minute chart all the way out to century-long cycles. It defines both bull and bear markets. So how do we actually tell these waves apart when we're looking at a chart? Well, there are 2 main types of waves, and the ones that drive the trend, those motive waves, they have to follow some very specific rules. It's pretty simple, really. Motive waves are the ones pushing the trend forward, and they're always made up of 5 smaller waves. Corrective waves are the pullbacks moving against the trend, and they're usually made of 3 smaller waves. Now, for a 5-wave move to be a valid one, it has to follow 3 unbreakable rules, no exceptions. First, wave 2 can retrace, but it can never go below where wave 1 started. Second, wave 3 is often the longest and strongest, but it can never be the shortest of the 3 impulse waves. And finally, wave 4 has to stay in its own lane. It can never overlap with the price territory of wave 1. If any of these rules are broken, your count is wrong. Simple as that. Okay, so just identifying the pattern is one thing, but the real magic comes when you start asking, how far can these waves go? And believe it or not, the answer might just be hidden in a kind of secret code found all throughout nature. I mean, that's the million-dollar question, isn't it? While nothing's guaranteed, Elliott discovered a mathematical relationship that gives us an incredibly powerful guide. The key he found lies in the Fibonacci sequence. It's this wild numerical pattern that just shows up everywhere, from the spiral arms of a galaxy to the petals on a flower. It's like nature's building block for growth. And out of that sequence, you get a very special number, 1.618, also known as the golden ratio. What Elliott found was that this ratio, and others derived from it, seem to govern the relationships between the waves in the market. It's almost like the market's DNA. So what does this actually mean for us looking at a chart? It gives us a practical tool. For instance, you'll see very often that a wave 2 correction will pull back about 61.8% of wave 1. Or that a wave 4 correction might retrace 38.2% of wave 3. These Fibonacci levels are huge for helping analysts find high probability spots for support and resistance. Okay, so we've got the patterns, the rules, and the ratios, but it is absolutely essential to understand how to use this thing correctly. And this quote right here, it just nails it. Elliott Wave is a game of probabilities. It is not a science of certainties. You have to remember this. The theory gives you a map of the most likely roads the market might take. It is not a GPS telling you exactly where to turn. You make your best wave count, you identify the possibilities, and then you have to wait and see if the price action actually confirms it or proves it wrong. The market always gets the final vote. So ultimately, the Elliott Wave Principle gives us a totally new lens to look through. It challenges us to look past all that day-to-day noise and ask a bigger question. Is this next move just random static, or could it be the next pulse in a pattern that's been repeating for over a century?